Hello, everyone. It's great to see you again. This morning, as I was sitting at my usual coffee shop in Manhattan, watching people rush by under a light drizzle, something suddenly struck me. Most of us are part of a very strange race. We trade our sweat, our time, and sometimes even evenings with our families for something called income. But have you ever stopped and asked yourself, is there a way for money to start working for me instead? Quietly, consistently, like the river flowing beneath a bridge? Today, I don't want to talk about flashing green and red charts or overnight get-rich promises. Instead, I want to break down an investment philosophy I call a blueprint for peace of mind. It's a way to build passive income that's not only strong enough to support your lifestyle, but also capable of growing on its own over time. But before we dive into the numbers, let me make one important and sincere disclaimer. Everything I share today comes from personal experience and is for educational purposes only. Personal finance is deeply personal, so always consult with your own financial professionals to find what truly fits your situation. Now, have you noticed how the investment world loves to celebrate home runs? Stocks that shoot up 500% or even 1,000%? It sounds exciting, sure, but that excitement often comes with a lot of sleepless nights. The strategy I want to discuss today goes against that crowd. We're not chasing flashy shooting stars that burn bright and disappear. Our goal is simple, yet profound: to generate a steady cash check deposited into your account every single month while protecting the capital you've worked your entire life to build. We're looking for balance, where growth and safety shake hands. To achieve this, our blueprint stands on three pillars I call the unbreakable rules of the game. First, and most important, capital preservation. A close friend of mine, a veteran Wall Street fund manager, once said, "Don't worry about how much you make. Worry about how much you have left when the storm passes." If you lose 50% of your capital, you need a 100% gain just to get back to where you started. That's a brutal math problem. So rule number one is simple: don't lose money. Second, we need resilient growth. I don't want a portfolio that only performs when the weather is perfect. I want a fighter, something that can take punches, get knocked down, and still stand back up. Third, risk-adjusted returns. This is critical. Sometimes staying out of a speculative frenzy, accepting that you won't catch the absolute top of a crazy market, is actually the best insurance policy for your future. We choose stability over hype. So how do we turn philosophy into action? We focus on assets designed to milk cash flow, specifically covered call ETFs and business development companies, BDCs. These tools allow us to generate income even when markets move sideways. And here's our secret sauce: reinvestment. Let compounding do the heavy lifting. Think of it like planting a tree. Every ripe fruit that falls becomes a new seed. Don't try to predict market tops or bottoms. Be disciplined. Be consistent. Our target is ambitious, roughly 20% total annual return. But here's the key difference. Most of that return comes from monthly income, not from hoping stock prices explode higher. Income does the real work in this portfolio. In professional circles, there's an interesting term: worsification. Many people believe owning more automatically means less risk, but when you own a little bit of everything, you dilute your returns and lose focus. I believe in a concentrated portfolio, about 25 to 30 positions you truly understand. Quality always beats quantity. However, be careful of a dangerous trap called NAV erosion. You'll see funds advertising eye-popping yields, 20%, even 30%. But look closer. If those dividends come at the cost of a steadily shrinking net asset value, then the fund is simply giving you back your own money. That's a dangerous illusion. Always look at total return. Zoom out. See the whole picture, not just the flashy percentage on the cover. Finally, let's talk about execution. In the US, sure, we have a major advantage: tax-advantaged accounts. Deciding which assets go into a Roth IRA versus a 401k isn't just a technical detail, it's how you keep more of what you earn. A skilled tax professional is an essential partner on this journey. I've shown you a sample portfolio with names like HDIV and QQQI, but remember this clearly: that's their blueprint. It's a suit tailored for someone else. The most important question I want to leave you with today is this: What will be the foundation of your blueprint? Why do you invest? To retire early? To fund your children's education? Or simply to sleep well at night without worrying about the ticker tape? When you truly understand your why, the how becomes clearer than ever. Now let's dive into the details of each holding in the sample portfolio and see how they work together, like instruments in a symphony orchestra. Now let's step inside the engine room of this blueprint. To generate a 20% annual cash flow without gambling your entire net worth in the stock market casino, we need real workers. In this portfolio, we don't rely on slow, aging giants. We choose smart financial structures. Take a look at how this portfolio is allocated. There's a truth I often share with my clients in the US. Confidence comes from focus. Instead of spreading capital across hundreds of tickers, this sample portfolio concentrates nearly 40% into just 4 core positions. That's not recklessness, that's conviction. When you've done the homework, there's no need to hide behind blind diversification. 1. HDIV, the versatile conductor. The first name I want you to notice is HDIV. If this portfolio were a house, HDIV would be the foundation. I often call it a fund of funds. Instead of you having to pick and manage individual pieces yourself, HDIV does the heavy lifting by holding a basket of strategic ETFs. And here's the key, it applies covered call strategies at scale. Ever wondered how you can get paid even when markets go nowhere? Think of it this way, you own a house. Instead of waiting for its value to rise so you can sell it, you rent it out every month. Covered calls work the same way. We rent out our shares by selling call options and collect the premium. HDIV gathers those premiums across multiple sectors and deposits them into your account every month. It delivers stability in an ocean of volatility. 2. HIS, when giants go to work for you. Next, let's talk about excitement. We all know the Magnificent Seven, Apple, Microsoft, Nvidia, and the rest. These tech giants power the global economy. But here's the problem, most of them pay little to no dividends. That's where his comes in. A friend once told me, I love Google, I love Amazon, but I need cash to pay my monthly bills. I can't wait 10 years to sell. His is the answer. It focuses on high-growth tech leaders and forces them to generate income through active option strategies. You stay invested in the AI era, in future technology, but you receive real cash month after month. This is how we turn tech volatility into consistent income. 3Q, QQI, a steel shield from the NASDAQ. And of course, we need a US anchor, QQQI. If you're familiar with the NASDAQ 100, you know it can soar, and it can crash just as hard. QQQI takes the core of those 100 leading tech companies and adds a protective layer. By selling call options, it gives up a bit of the upside during manic rallies, but in exchange, it creates a buffer and a highly attractive income stream when markets get choppy. Here's something I want you to remember. In investing, good enough is often better than perfect. You don't need to ride every tsunami to build wealth. You need a sturdy ship, one that keeps moving forward and keeps storing fuel along the way. The overlooked detail, currency diversification. There's one subtle detail in this blueprint that many people miss because they're too focused on the tickers. Currency diversification. By holding both Canadian and US assets, you create a safety net against currency swings. Over the years, I've seen too many investors wiped out, not because they picked the wrong stocks, but because they put all their faith in a single currency. True wisdom lies in spreading geopolitical and monetary risk inside your portfolio. A simple question for you. If you woke up tomorrow and global markets were down 10% across the board, would you panic and sell? Or would you smile knowing your dividend income is still scheduled to hit your account at month's end? That difference is mindset. When income becomes the primary objective, volatility stops being the enemy. It becomes a companion, sometimes even an opportunity to reinvest at better prices. The final thought. Don't build a portfolio just to brag about massive returns in one lucky month. Build one that 10 years from now is still quietly working, still steadily printing cash, and still giving you the freedom to focus on what truly matters. family, passions, or simply a peaceful morning with a cup of coffee without financial stress. That is real freedom. We've talked about planting seeds, about choosing the strongest trees in the garden. But here's a hard truth on Wall Street. Making money is only half the journey. Keeping it and enjoying it wisely is the real destination. One of the biggest mistakes I see among investors in the US is rigidity. They build a great portfolio, but they fail at harvesting. Today, I want to share two critical elements of this blueprint: tax management and dynamic withdrawal strategy. Choice 1. Tax management. Stop the leaks. Think of your portfolio as a bucket filled with water. You work hard every day to fill it, but at the bottom there are tiny holes. Those holes are taxes. In North America, we have a saying, it's not how much you make, it's how much you keep. That's why asset location matters so much. A friend once asked me, why do we own the same investment, but my year-end return is lower than yours? The answer was simple: the wallet holding it. For U.S. assets like QQI, placing them inside accounts such as a Roth IRA or RRSP isn't about saving a few dollars. It's about protecting decades of income from tax erosion. For Canadian domestic stocks, a TFSA can turn your cash flow into completely tax-free income. Understand this clearly. Tax management is not about avoiding responsibility. It's about optimizing resources so you can take better care of yourself and reduce future strain on society. 2. Dynamic withdrawal strategy. Spending with the market, not against it. Now let's talk about enjoying the fruits of your labor. Most people have heard of the 4% rule. Withdraw 4% of your portfolio each year. But life doesn't follow a fixed number on paper. Markets have boom years and dark winters. If you withdraw a fixed amount while the market is crashing, you're cutting into your capital when it's weakest. That's called sequence of returns risk. In this blueprint, we use a dynamic withdrawal strategy. In strong market years, you can withdraw a little more, travel, upgrade your home, enjoy life. In financial winter years, you tighten up. Live off dividends only and leave the principal untouched. Do you see the power in that? By moving with the market's rhythm, you never slaughter the goose. The goose stays alive and keeps laying golden eggs year after year. 3. Cash management and cash drag. There's one more subtle issue I want you to pay attention to: idle cash. In an income-focused strategy, letting cash sit in a checking account earning nothing is a quiet betrayal of your own effort. I always recommend automation. Dividends arrive? They should immediately flow into money market funds or be reinvested if you don't need the cash yet. Don't allow your money even a second of unnecessary rest. Final thoughts. A financial journey is like a long voyage at sea. The blueprint we've discussed isn't a rigid map, it's a compass. It reminds you to not get greedy when the crowd is losing its mind over the latest trend, not panic when headlines are flooded with fear, and above all, to trust the power of consistency. Let me end this video with a question. Who is truly wealthier? A 60-year-old man looking back with regret for not starting sooner? Or a 25-year-old who begins with just $100 a month, guided by the right blueprint? Time is the most valuable asset, not money. Money is simply the tool that allows you to buy back your time. Start sketching your own blueprint today. It doesn't need to be perfect. Just start. And if you found these insights helpful, leave a thought in the comments. I'm always here to listen and walk this path with you. Goodbye for now, and I wish you a calm, steady investing day.